My belief is we'll probably end the year at 3,000 gold. If you go back into the 70s and you look at the amount of the money supply in the United States, you divide it by the 261 million ounces that the U.S. owned, you could get close to the reference price of $35 an ounce. If you did that same math today, all the money outstanding divided by the ounces we own, gold would need to be $80,000 an ounce, and it's at 2,300. Now, I'm not suggesting we're going to go to that anything close to that number, but what I am suggesting is that the suppression of the price and the ignoring of gold by most investors for the past 10, 15 years, because in a deflationary world you didn't feel like you needed it, I think that's set to violently mean revert in the other direction.
Gold prices surged to a 6-month high on Friday, reaching $2,365 during the Asian trading session. This rise comes as investors seek safe haven assets amid ongoing economic uncertainties and inflation concerns. Lawrence Lepard of Equity Management Associates predicts that gold could hit $3,000 by year-end. He bases this forecast on the disparity between the limited global gold supply and the abundant fiat currency, which he believes will drive prices higher. However, current risk-on market sentiment may cap gold's immediate upside potential. Investors are closely watching economic indicators and central bank policies for clues about future trends. Recent U.S. inflation data has shown signs of moderation, with the Commerce Department reporting that monthly inflation remained unchanged in May. A slight increase in service costs was offset by the most significant drop in goods prices in 6 months. This data has fueled speculation that the Federal Reserve might be approaching a point where it could consider interest rate cuts later this year. Federal Reserve Chair Jerome Powell emphasizes caution in monetary policy, warning that premature rate cuts could reignite inflation and force a return to harsh rate hikes, highlighting the complex economic challenges facing policymakers. Meanwhile, Lawrence Lepard offers a broader perspective, arguing that the global economy has transitioned from a long-term deflationary environment to an inflationary one. He predicts this shift will drive precious metal prices significantly higher in the coming years. Contrasting with the Fed's more cautious short-term outlook, Lepard forecasts a 5 to 10-year inflationary commodity cycle, potentially ending in a currency reset. He views the current gold rally as part of a long-term uptrend rather than a short-lived spike, suggesting sustained growth in precious metals prices over the coming years. Join us as we delve into Lawrence Lepard's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you, and enjoy the video.
Gold is really good at sniffing around the corners, looking around the corners. I think what gold, we all look at the monetary situation, and I say we, those of us who are Austrian in background, look at the monetary situation, say this is messed up and it can't continue. And the gold market, I think, is kind of a good measure of kind of the Austrian economic views. And I think what the gold market smells is that they are going to have to print a lot more money at some point in the future. And the market's saying, you know what, I want to get in front of that, even though they haven't started that printing process yet. It's interesting. We couldn't foresee COVID coming. And yet, and gold was kind of trapped below 1365 in 2019. And yet we had the repo blowout that year, and gold went from that 1365 up to 18 or 1900 before the repo blowout. And so, again, gold kind of sniffed out the future inflation. I think that's what's going on. My belief is we'll probably end the year at 3,000 gold plus or minus. And the thing I think it's important to understand is just how asymmetric gold is, how little gold there is in the world, and how much fiat paper there is in the world. There have been great studies that have shown if you go back into the 70s and you look at the amount of the money supply in the United States, you divide it by the 261 million ounces that the U.S. owned, you could get close to the reference price of $35 an ounce. If you did that same math today, all the money outstanding divided by the ounces we own, gold would need to be $80,000 an ounce, and it's at 2,300. Now, I'm not suggesting we're going to go to that anything close to that number, but what I am suggesting is that the suppression of the price and the ignoring of gold by most investors for the past 10, 15 years, because in a deflationary world you didn't feel like you needed it, I think that's set to violently mean revert in the other direction. Because I don't think we live, we had deflation from the early 80s all the way into 2020. And I think that changed. We hit peak deflation in March of 2020 with the COVID crisis. And now I think we live in an inflationary world. And if that's the case, then, gold and silver are going to be multiples higher of where they are today. in 5 years or 10 years, and Bitcoin will be too. So, I remember very clearly, it was interesting in the early 80s when I was in this business. At the time, stocks were a terrible thing to invest in. You wanted to own gold, you wanted to own commodities, you wanted to own inflation protection. I'm talking about 82, 3, 4 time frame. And the reason for that is because you just come through the inflationary 70s, and the only people who had made money in the 70s were people who invested in inflation, in the inflation trade. So everyone tended to look backward in 82, 3, 4, right? We've just had an enormous period of deflation, and everyone who's made money has made it in stocks and bonds. And yet, the trend clearly is reversed, in my opinion. But people are still thinking we're going to go back to low inflation, deflationary world, and you don't need inflation protection. And my belief is the polar opposite of that. And by the way, in 82 or 83, that was a great period to buy stocks. You were just about to start a 40-year bull market in stocks. I don't know that this one's going to last 40 years, but I think this inflationary commodity cycle has easily got 5 to 10 years to run. And then perhaps we reset the currency because we've got too high inflation and the problems have become so obvious. So with that in mind, to me, it's very early days for investing in gold, silver, Bitcoin, and gold and silver mining companies, which is what the fund I manage does. We pick gold and silver mining companies. So
Federal Reserve Chair Jerome Powell's recent statements and the latest Fed minutes unveil a complex landscape of monetary policy considerations. In his Tuesday appearance, Powell portrayed a fundamentally robust U.S. economy and job market. He suggested that this assessment affords the Fed the flexibility to decide when to implement interest rate cuts. Most economists agree with this cautious approach, foreseeing a potential first rate cut in September followed by a second by year's end. However, some market observers, including Lawrence Lepard, challenge this consensus. Lepard predicts a surprise rate cut before the upcoming election, arguing it would stabilize the economy during this period and ease short-term government borrowing costs. Let's get back to the interview.
Let's just consider that, I don't believe any of the government statistics, but setting that aside, let's say you did believe this. This provides the Fed with a cover they need to claim that they've got inflation going in the right direction and under control and to cut interest rates. And so even though the market is saying that they don't expect interest rate cuts until, later in the year, perhaps end of year next year, I bet the Fed's going to surprise us because I think they need to cut interest rates in order to try and reduce the U.S. federal interest expense. They need the Treasury bill costs to come down because they're financing a lot of the deficit in the short end of the curve. And the short end of the curve is, because the Treasuries, yes, because they're hand in glove, the two. I mean, you're right, it is the Treasury's problem, but the Fed knows that if, they understand that the U.S. government fiscal situation will come unglued if they're not able to get rates lower and bring rates lower. And so I think they will. I'm actually calling for a surprise cut sometime between now and the election. I don't think that's what the consensus view is, and I think these kinds of numbers, these kind of PCE inflation numbers, which you mentioned, are, they're awfully convenient. Are they cooked? Who knows? But there's certainly been a lot of work done by a lot of very smart people to suggest that the government, manipulates the inflation figures. I mean, John Williams at Shadow Government Stats does great work on this. So, my belief is that what they're going to do here is cut rates that will, hopefully allow them to pay a little bit less on the short-term borrowings and keep the economy going through the election, which is kind of, they're one of the major goals that they must have. You can see both sides of that equation, and it's possible, I would actually argue that if they're really trying to restrain the economy, the rates aren't high enough yet. But a rate that would be high enough to truly restrain the economy, would also break a lot of things. So, we saw that last fall when the Treasury bond rates, the 10-year rate went from under 4 to over 5 very quickly. And the Fed speakers came out and jawboned it down very quickly. The government's in a very precarious position. The U.S. federal government's in a very precarious position at a lot of different levels. I mean, the debate showed that at the political level, that's the case. But if you actually go and look at the math on the budget, and the CBO just came out, Congressional Budget Office just came out with a revision of their estimate for the deficit this year, and it's now 1.9 up from 1.5. That's a 27% increase. The last estimate was made in February, so we're only talking a few months, 3-4 months, and they already increased it. I think it's going to be higher than 1.9. And so, this government really cannot stop spending. That's the underlying problem that's being faced in the United States, in my opinion. And eventually is going to express itself in the debt market and then in the sound money markets, gold, silver, Bitcoin. It already has started to express itself. I mean, even at 60,000, Bitcoin's up 50% this year. Gold just broke out of a 3-year high of 2070, and silver just broke through a 3-year high of kind of 24, 25, 26, and scored it up to 32. It's backed off that now. But the point is, I think that these sound money alternatives are all smelling what the government is about to do.
Lepard's perspective revolves around concerns regarding U.S. government interest expenses. He argues that a significant portion of the deficit is financed through short-term borrowing at current high rates, putting pressure on the Federal Reserve to reduce rates and alleviate this financial burden. The recently released Fed minutes reveal internal disagreements among policymakers, complicating matters further. Some members advocate potential tightening if inflation persists, while others stress readiness to respond to economic weakening or labor market deterioration. With these conflicting views and predictions of a prolonged inflationary cycle, investors face the challenge of balancing short-term volatility with the potential long-term gains in gold and silver markets. Share your perspective in the comments if the video resonates with you. Join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.